Hello, chart watchers, and welcome to this Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Volatility index, despite the selling today, you can see the volatility index is currently down below 18 at its lowest level since back roughly a month ago. The financial group got off to a great start on the back of some pretty solid bank earnings, but you can see a bearish engulfing candle. This will be worth watching throughout the day. Bank stocks, as you can see, really struggling after early strength at the open. We have rolled back over, and after capturing the 20-day moving average yesterday into the close, so far we are losing it, but just keep in mind this is an intraday candle. Let's see how we finish today. JP Morgan reported great results, gapped up at the open, but led the bank stocks lower. PNC Financial actually gapped down today, but is testing fairly significant short-term price support. That one will be interesting to watch throughout the day as well. Energy continuing its strength, moving higher today above $71 after the recent breakout above that 69 area. So that winning streak of higher highs and higher lows is remaining intact. And you can see the exploration stocks moving higher as well. Many areas of energy performing well. We'll talk about that in just a few minutes. But first, let me bring in my co-host, Erin. How are you doing this morning, Erin?
I'm doing okay. The Ducks got shut out last night, so
I'm blaming. Okay, today's Friday the 13th. We've already had technical issues here with the show. I'm blaming last night's hockey results on Thursday the 12th.
I agree. I agree. Tomorrow night is another night, though, and home game. I'll be there cheering. Hopefully, we'll score a goal this time. So,
yeah, the only thing different for the Caps was the opponent. We're always losing in the playoffs. It's usually the Penguins. We found a new opponent to blow a game to last night, leading until, I don't know, 3 or 4 minutes left in the game. Dumb penalty. They come back, tie it, and then they beat us in overtime. It's like, really? Here we go again. It's playoff time in Washington.
yeah.
Anyhow, we got a lot to get through, so I'm gonna go ahead and let you take over with the announcements for this week and upcoming week and today's agenda.
Absolutely. So this week, of course, we're finishing the week with my workshop today. Next week, Tuesday, everything stock charts. We'll have one of our Seattle folks down to tell us more about the market and what you can do on stock charts. Tim Ord from the Ord Oracle will be here on Wednesday. He is one of our top advisors in the Top Advisors Corner. Julius is coming back on Thursday. Yay, I didn't even know that. I'm excited. I'm looking forward to talking to him. And then on Friday, of course, it'll be Tom's turn to do a workshop. So that'll be my day off. But today, I'm on. So if you look at the schedule today, you'll be hearing my voice quite a bit. We will be doing a workshop, as I said, divergences and confirmations. I found out a few things that I wasn't completely familiar with, so it'll be interesting to explain all of those to you. 10 and 10 to 1. We have Vista Outdoor. That will be our first symbol, and Tom is busily getting ready for that particular chart as well as others. And then finally, we'll finish up with a sentiment update, and the times may be a little different since we did get a bit of a late start today. And with that, I'm going to pass it to you, Tom, for those technical headlines and news.
Yeah, we've got first got the 10-year Treasury yield here up on the screen for you. You can see we did try to get through the 50-day moving average. We tried this once before, about a week and a half ago. Made it on, just barely at the close, and then came right back down below. Tried again earlier today, and so far failing. And of course, anytime we get a potential top in the 10-year Treasury yield, that could have a negative implication in the financial space, and we're seeing the financial struggle today, and we'll get into that a bit more in just a minute. We did have one economic report out today at 10 a.m. The April consumer sentiment was released. 97.8 was the actual number. The market was looking for 101.0, so we did come up a bit short there. I do also want to mention that tax day, if you're here in the U.S., tax day is April 17th this year. So it is on Tuesday, and you might say, well, why is that? The 15th falls on the weekend. It should be on Monday. Well, this year, Emancipation Day. It's a local Washington, D.C. holiday. It is Emancipation Day, and it falls on the 16th, which is Monday. So you have an extra day to procrastinate to get your taxes in. And for those of you wondering, Emancipation Day was the date that President Lincoln freed the slaves in D.C. in 1862. So just a little bit of history there. Today's action so far, I'll pull up the S&P 500 and can tell you that the top of the S&P 500 is littered with energy stocks, while the bottom of the S&P 500 is littered with bank stocks. So it's clearly energy in the forefront today and banks taking a back seat. But so far, we have gapped up above the 20-day. We gapped up earlier today, by the way. We started strong, got up to about the 2675 area, actually opening up about 2677. We pulled back, went below the 20-day moving average, and now currently we are back up above it at 2661. I would be a little careful if we fall back below that 20-day moving average. If there's one thing that I think does look good, it's the fact that the market reverse started going lower, and yet we see the volatility index continuing to move lower. That to me tells us that the market is beginning to feel a little bit more complacent, and that generally is associated with the resumption of the bull market. Now, we have not taken out the key levels that we saw, the lows back in March, so I'm not ready to suggest that we're going to go straight higher, but this is the time of the month within April when we do tend to see the market move higher in anticipation of the earnings reports that'll be coming up. And by the way, today's earnings reports, I'm going to pull up some of these. JP Morgan, they came out, they beat top line, beat bottom line by 9 cents, 237 versus 228, gapped up. It looked like we were off to the races, but you can see that open at 115.02 was essentially the high of the day. We did get up to 115.15, but it's been a reversal. And right now, I do not like the looks of that bearish engulfing candle, but the day is not over. So we're seeing a lot of volatility in the bank stocks, big gap up at the open, big sell-off, trying to come back up. If we can move back up and hold on to the 20-day moving average, that would be one positive to take away from today. But volume is very heavy. As you can see, JP Morgan already near 20 million shares, and we've still got another 25 minutes or so to get to the halfway point of the day. So this is an important candlestick to watch. And if it's a reversing candle, today's open is going to become very important resistance down the road. And the recent lows down around 106 are your support. So at this point, I would say JP Morgan's in about a 9-point trading range. A couple of others that came out. Citigroup missed on their top line, but did beat 168 versus 161 on the bottom line. Gapped up to the 50-day moving average and has a candle, looks fairly similar to what we just looked at on JP Morgan. PNC, also a very slight miss on their top line, but the bottom line beat 243 versus 242. And you can see I actually like PNC, and I actually nibbled on it today just recently, right before the show started, as a matter of fact, because it did put in a lower low beneath these prior lows and then has reversed. I have a very tight stop. If it goes back down below today's low and sets new lows, I'll get out. But I'm taking a chance that maybe it is setting a bottom. The other stocks, I don't really have a lot. The other bank stocks, that is, I don't really have a good area to put in a stop. WFC is at support as well, but I think this has been one of the worst performers among the banks on a relative basis. So I'm not particularly interested here. But if you look at that relative 1-year chart that I like to flash up here, you can see bank stocks have actually, been pulling back, but they're above the lows that we saw in November. And yet Wells Fargo is down below those lows. And you can see that more clearly here when you compare WFC, Wells Fargo, versus the bank index. It is setting new relative lows, and it's been declining for quite some time. So even if you like the banks, to me, Wells Fargo is not necessarily the stock to look at. I like PNC. I like JP Morgan. I like those much better. But you can see on a relative basis, the last couple of months, banks have really been struggling versus the S&P. But we are at a key relative support level. And when we look at the banks themselves, they are still holding the recent lows. I think if we lose those lows and break down to new, fresh relative lows, then I think we've got some problems, and I would be careful with the group. But I'm still looking for the 10-year Treasury yield to move higher, so I would expect that financials and particularly banks would do pretty well. I mentioned the energy stocks, so let's take a look at the XLE. XLE making a nice move to the upside. This is a fourth consecutive day since breaking out above 69 that we are putting in higher highs and higher lows. The PPO looks great. I think this group is very, very strong, becoming overbought, getting close to overbought territory, which would be the first time since back in January. But I think the XLE has room to move to the upside. We've talked about this recently on the show, where the crude oil prices have broken out above January highs, and you can see the XLE still trying to play catch up, not even close to its January highs. So I think there's more room here to go. A couple of areas within the energy space here is the exploration and production index. You can see breaking above 710, moving straight higher. The DJUSOL, which is the integrated oil and gas index, doing the same thing, breaking above recent highs, getting that golden cross, the 20 above the 50. I think that looks good. And one index that we have talked about quite a bit here in the last few days, the oil equipment services index, breaking above 420, also breaking above that 430. I don't have it here on this chart, but if you go back a couple more months, you'll see that there was a top around 430. We're clearing all of that. So I think oil equipment and services look pretty good here. A couple stocks in the news this morning. Qualcomm. Qualcomm came out and, there are reports that their former chairman, Paul Jacobs, could make a bid for the company within the next few months. Stock gapped up. It's one of the better performers in the Nasdaq 100 today, but it is putting in a black candle right at the 20-day moving average. And for those of you who are thinking about this as a possible investment, well, good luck. I'm not a big fan of Qualcomm. I just think longer term, and I'm going to go back. Let's take a look 10 years, and we'll do a weekly chart. But this is Qualcomm relative to the Nasdaq 100. Now, again, if you're trying to outperform, is this the stock you want? I mean, it's had very few periods of really strong relative strength. We saw it in 2016. We saw it maybe for about 9 months back in 2010 into 2011. We saw it very briefly back in the fourth quarter of 2017. But we're near 10-year relative lows right now in Qualcomm versus Nasdaq 100. So if you want to chase the headlines, I would be careful. This has not been a very good performer. Another stock that was in the news with Qualcomm recently, this is Broadcom, AVGO. And of course, Broadcom was looking to acquire Qualcomm, but this is another stock that's been going sideways for a bit. You can see the pop today. That is as a result of AVGO authorizing the repurchase of up to $12 billion of its own stock. So definitely a nice movement today. But again, this is a stock that has not been doing very well over the last several months. And relative to what we've seen in the overall market, probably not one of the better stocks to be looking at, in my opinion. And with that, I'm going to turn it over to Erin and let her get into her workshop. Take it away.
All right, let's get this going. So today I'm going to talk to everybody about divergences and confirmations. So let's get started. I am Erin Swenlin of Decision Point, and we're going to look at divergences and confirmations today in my workshop. So we're going to cover, first of all, I want to give you a rising bottoms and declining tops line refresher. So we'll start with that. Then we're going to look at some classic divergences. And then I'm going to show you some classic confirmations. But then we're going to cover a few advanced methods, and that would be converging and diverging moving averages, as well as something called hidden divergences. And that one was actually somewhat new to me. I've seen them, I've heard of them, but I don't use them. And I'll talk about that a bit later. So first of all, we need to look at what rising bottoms and declining tops, of course, look like. First of all, you want rising bottoms because that gives you support or an area to watch for testing of price. And then declining tops, of course, that forms resistance. And there's really no such thing as a declining bottoms line, and there's really no such thing as a rising tops line. And if you look at this, it should make sense. We want to see rising bottoms so that that's the test line, right? That's the support line. So what's important is that holds as support. You don't want to see anything break down below that. Well, if you're looking at a declining bottoms line, well, what are you going to get out of that? Sure, it could go down below that, and maybe then you're seeing kind of an increase in the price trend going the wrong direction. But in general, a declining bottoms line is considered not valid for that very reason, is you want to think about what's important to get out of that particular line. So the declining tops, of course, that is also valid because what you're looking for is a change in that trend. You've got a declining trend, declining tops. So you want to watch that as resistance and you want to see it break out, and that gives you information. If you're looking at a rising tops line, you're not going to get much information if it goes above it. You're not going to see anything. It doesn't form support of any kind. So it's not particularly useful. Now, of course, you could draw rising tops and declining bottoms lines, but as part of a trend channel. I didn't draw that in for you, but I think you can understand that. So if you're looking at, the trend itself and see if it's matching, and then you could have that, obviously you'd end up with a rising tops and a declining bottoms if you were looking at a trend channel. But in general, when you're looking at trends and how we draw a valid trend line, that's how you do it. Now, let's talk about measuring divergences, because knowing how those declining bottoms are rising bottoms here, or just doing that too, declining tops and rising bottoms lines. The reason that's important is because you want to start with the indicator when you're looking for divergences. Draw your rising bottoms or declining tops lines. Remember, those are the valid lines, but you're starting with the indicator. So you're looking at the indicator and you're going to draw your rising bottoms or your declining tops. Next, you'll draw the same thing on the corresponding price bottoms or tops. Now, of course, in this case, you might end up with a rising tops, or you might end up with a declining bottoms line. But that's okay, because really what we're talking about is the indicator. We want to start with that, and then we move to the corresponding price bottoms or tops. You then compare those slopes. If it's the same slope, if they're both going up, that would be a confirmation of that trend or the rising trend. So the same slope, you're talking about a confirmation. If you get a different slope, now you're looking at diverging lines, right? So that's when you get the divergence. All right, so let's look at a few here. So a bullish divergence, start with the indicator. Look for rising bottoms. That's a rising trend, right? In the indicator, that's what you're looking for. And then you connect those corresponding lows in price. And there you have your divergence. This is considered a bullish divergence. And you can think about it this way. You've got, for example, let's say this is a momentum indicator. If you're getting rising bottoms, that's telling you that even though you have these the momentum may go negative and come back, it's turning up quickly. So you're seeing an increase in that momentum. If you start seeing the lower price lows, well, that's not really going with what you're seeing here. But the fact that the momentum is rising should tell you that despite having lower bottoms, you're going to get a move to the upside. So it's considered a bullish divergence. Let's look at it on a chart real quick. Started with the indicator. This is the price momentum oscillator, the PMO, the decision point indicator out there. And in my opinion, the best momentum oscillator. That's another story. So let's look here. We start with the indicator and we're looking at these rising bottoms. And then we come here and we see declining bottoms here. We're getting lower lows on price, but higher lows on the indicator, and that's considered a bullish divergence. And in this case, it seemed to be portend to the future somewhat. We're getting that move, that rising trend off of that divergence. You could also call that a positive divergence, bullish divergence or a positive divergence. So let's look at a bearish divergence. Start with the indicator, declining tops. Declining tops. And when we compare that to the tops on price, we can see the tops on price are getting higher, but momentum, if that's what you're looking at as far as this indicator, is moving lower despite that price is moving higher. That's telling you there's a divergence, obviously, two lines are diverging, but it tells you that there's problems. If you're losing the momentum and you're going on a price rise, that tells you that there's a problem on the horizon. You should start to expect this rising trend in price to reverse. And let's look at it on a chart. Start with the indicator. declining tops, the valid lines, declining tops, rising bottoms. Start with the indicator. So we have declining tops on the PMO, and we have rising price tops. So we're seeing a deterioration of momentum, yet price is trying to push higher. It's similar to volume leading price, because you can also use this on balance volume, chicken money flow, any of those types of volume indicators. You can also use this for that. So think about it in that regard. If you're getting volume starting to dry up, but price is still going higher, that's telling you there's going to be a reversal in the trend. So you end up with a bearish divergence. So sometimes it's easier to think about in terms of volume. So let's look at some bullish and bearish confirmations. And what's the difference? Remember, with the divergences, the rising bottoms line would be divergent from the price bottoms. So in the case of a confirmation, we look for the slope of the indicator. Remember, declining tops, rising bottoms on the indicator. There you go, rising bottoms, declining tops. Now you look at the slope for the price by drawing the coordinating bottoms and tops to what you drew for the indicator. If that is the same, you're getting a confirmation of the trend and what's going on. So let's look at it here. We have a bearish confirmation. Momentum is being lost, as you see these declining tops, but you have price tops also going in that direction. So you're losing momentum and you're losing price. It's basically confirming the fact you are in a negative trend. And it's similar for bullish confirmations. You see rising bottoms and you're seeing rising price bottoms. Momentum is increasing, or if this were a volume indicator, volume is increasing, price is increasing. That tells you that you should expect the trend to continue. It's a bullish confirmation. All right, so let's talk about some advanced concepts here. And I'm going to slow down just a bit because these can be very confusing. The hidden divergences. We're going to look at something called hidden divergences. And I've seen these. They're not used in classical technical analysis. I mean, I've been studying for the CMT designation, and so far all of the materials that I've been reading for that, none of them discuss the hidden divergences. So this is sort of an outlier, but it is something that's out there, and you can look at that. So let's talk about that just a little bit. Oh, and converging and diverging EMAs, they can be either a warning or a attention flag, or they can be confirming the trend. So it's sort of the same thing, divergences and confirmations. So let's start with hidden divergences. And I almost did not include this in this workshop because it might confuse the concept. So let's just remember, before I get into this, starting with the indicator, rising bottoms, declining tops. Okay, the difference with hidden divergences is instead of starting with the indicator as far as declining tops and rising bottoms, you start with the price and you look for those bottoms and tops in price. That's a way to remember it. You're switching it around. So in price, you're looking for rising bottoms and declining tops like we usually do on price. And then we look at the corresponding tops and bottoms on those indicators. So it's a reverse of that process. And that means that it's the reverse expectation as well. So if you have higher highs on your indicator and you have lower highs, the declining tops here, right? Like I said, price will give you the classic rising bottoms or declining tops. And then you're going to be looking at the indicator and see what's going on with the tops and bottoms. And in this case, you have rising tops, declining tops. That's considered a bearish divergence. So rather, it's a reversal to some degrees. All right. And then here is a hidden bullish divergence. So you're looking at higher lows, rising bottoms on price, And then you're looking at lower lows on your indicator, moving lower. Declining bottoms, I don't even use that term because it's, again, it's not really what you're going to get. So, okay, so it's, again, reverse. So you're looking at rising bottoms and you're looking at these momentum indicators, volume indicators, whatever it is. You're getting the momentum is starting to really deteriorate here, but price lows are still rising. So that's telling you that despite you're getting that back off on price, right? And then you're getting that momentum is getting much lower. So really what happened was in this decline, you ended up seeing that momentum or volume very quickly decline. And so it's gotten more oversold. And so that would be why you have it being a bullish divergence. So it can be confusing, obviously, because, you know, again, it's trying to figure out where you start as far as drawing those valid trend lines. So in the hidden divergences, you're going the other way, which means what you're expecting is going to be different. So you would think you've got lower lows on your indicators, so that seems like a negative connotation to it. But in actuality, because you've got the rising bottoms, that makes it a bullish divergence. So again, I know, kind of confusing here. So let's look at the hidden bearish divergence. You've got declining tops. That's your valid trend line. We started with price, declining tops. What's happening with the indicator? You're getting rising tops. So again, that's considered a hidden bearish divergence. Now, in this case, it didn't result in a huge decline at all. When we look at the hidden bullish divergence, we have rising bottoms, and then we look at what's going on with the indicator, declining bottoms. It's a divergence, and that's considered bullish. And the expectation would be a rise, and we actually did see that here. I don't think you really need to use these hidden divergences. I personally think that it's probably going to confuse the point. I think it's much better if you're looking at just the classical divergences. They give you all the information you need, and if they aren't diverging and they have the same slope, then we know that's a confirmation of what's going on. A lot easier to remember. So I wanted to present these hidden divergences, but I also wanted you to understand that it's not really used in classical analysis, and it can kind of confuse the point. So let's look at converging and diverging EMAs. So when you're looking at converging EMAs, that means you're working toward some sort of crossover. It can be a warning if you're working toward a negative crossover. And if you're starting to work toward a positive crossover, that's, you know, an alert. Hey, something good is getting ready to happen. Diverging EMAs, when they start to move apart, that tells you that you're getting a confirmation of the trend because price is accelerating in that direction. And so the EMAs are separating. So let's look at this a little more closely. So right over here, we have 3 warnings that there's going to be a downtrend. Notice that we have these EMAs and they are split, right? They diverge, they're moving further apart because you've got price accelerating to the upside. But then you start to see price move lower, and now you're seeing these moving averages start to converge on each other. So that's warning you, because of course you're coming in for that negative crossover, that's warning you that a downtrend is now in place, and you should be thinking about more bearish outcomes in these cases here. And in this case, of course, it really turned out to be bad news. Of course, the market suffered quite a bit through here anyway, but let's look at the confirming trend. And as you can see, we came out, got that crossover. It looks like a kind of a whipsaw decline and then move up. But you're starting to see at this point the EMAs start to separate and diverge. And that's telling you that that price trend is getting stronger as we move up higher. And here we go again, like I said, squeezing EMAs, and we're getting close to that negative crossover. And so that's giving you warning that the trend is likely to be changing. And similarly here, we can see the confirmation of that trend after we got the crossover. The EMAs are starting to stretch and move further and further apart. Over here, and I didn't draw it in, notice as soon as we start to see a squeezing of these EMAs, we start to see the distance not be as great. That's telling you to expect, that the trend is changing, and you can already see it was starting to change, and that's confirming that fact. So that's what you look for when you're looking at converging and diverging EMAs or moving averages. So that concept, I think the light bulb may have gone on for a few people. Remember the MACD? It's a moving average, convergence, and divergence. So this particular indicator gives you that information that we just saw on this chart back here, where we watch for the compression and decompression of those margins between the EMAs. So now we have an indicator that, of course, measures that. So let's go ahead and review. Remember that the MACD is the difference between two moving averages. And then you get the signal line by taking the 9-day EMA of this difference. So it's the difference between those two EMAs, which is telling you what, obviously, we'll get there. The histogram shows visually that squeezing and diverging of those EMAs. So let's look at that example here. So here's the MACD, and this is the 12-day EMA and the 26-day EMA. Your larger period EMA is going to be the slower one. So, well, I take that back. This is the difference between those two. And then this is the average of those. And so what we look for in the histogram is we're looking at the space between those two moving averages, essentially. And that's where you can start seeing the compression. As soon as you start seeing that histogram move down, you know that there's compression starting to take place. That's giving you that warning that there's possible reversal in trend setting up. And that's how you use the MACD. That's how it was determined, and that's how you get that. All right, so let's go over pretty much what I just talked about, and I'm going to cover a few charts. We'll just go look at a few as well for some examples. But I just wanted to refresh you on what we just looked at. So remember, we looked at what constitutes a valid trend line: rising bottoms and declining tops. Those are the only valid trend lines. We looked at classical divergences, and that was where you started with the indicator using this tool, rising bottoms, declining tops, using those valid trend lines. We started with the indicator, and then we looked at price. And when it diverged, when those two diverged, obviously that's your divergence and your classical confirmation when you're confirming the trend. Or confirming the momentum, whatever indicator it is, confirming the volume. You want to look for those declining tops and rising bottoms on the indicator to match, to make that a confirmation. And then we looked at a couple of advanced methods, which are those hidden divergences. And again, you can use those, but for me, I prefer to stick with the classical versions just to keep my head straight. Converging and diverging moving averages, we discussed the significance of looking at those divergences and convergences of those moving averages, because that gives you a hint as to, or a flag as to a trend that is improving or being confirmed, or it is telling you that you're getting ready for a warning or an attention flag because you're getting ready to have a crossover between those two moving averages. All right, so let's go ahead and we'll go look at a few examples here. And I'm just going to take a few of them cold. How's that? And see what we can see. Actually, no, I want to show you first, as an example, one of my favorite indicators here. And that would be the decision point indicators. And I'll show you the ultra short term, and intermediate term. And I know there's going to be some confirmations and divergences on there. There always are. Okay, so let's look at this one, and I will go ahead and annotate. But I probably will not save those annotations. All right. So I want to get some trend lines going here. So let's move some of this stuff out of the way. Here we go. So remember, we're going to start with the indicator. So we don't want to look at rising tops, no such thing, right? We want to look at declining bottoms. There we go. Where are the corresponding tops on price? They are rising. What is that? That is a bearish divergence. And so that would tell you it's an intention flag. It's a warning that the trend is going to change. Well, in this case, let's face it, it worked out really well. Doesn't always work out that well, but there you go. So that was a bearish divergence. So now let's look and see if we can find some rising bottoms here. Here's rising bottoms on the advances minus declines in breadth. And now we're going to look at the corresponding bottoms on price, and they are declining. So that is actually, no, wait, we want to go to the tops, my bad. Compare tops, let's see, the bottoms to the bottoms. Hey, no, that would go down here. All right, declining bottoms. So in this case, you're looking at rising bottoms and you're looking at declining bottoms, and that is considered a positive divergence. And in actuality, when I look at this, of course, these lines are actually converging, but we're looking for the differences in those lines. So again, bottoms to bottoms, tops to tops, and we start with the indicator. So in this case, this was a bullish divergence. And what came out of that, we saw that move upward, and we got that trend change. So that was in the climactic indicators. Now let's look at the short-term indicators and see if they are coming through the same way. One thing I am just, honestly, I'm kicking myself about because I haven't seen it, and it gave us a really good warning on this decline. Let's look at the divergences going on here. All right. Okay, so what I was actually doing in this case where we had this move upward, and this is a little bit of an advanced concept because I'm going to actually look at the difference between these two indicators. One is on breadth and one is on volume. So I have a declining tops right over here on the volume. Typically, you're going to see these two go in the same direction. So let's show you a few of these. This is typically what you're going to see. They always really follow each other. So in this case, I have declining tops on volume, but what ended up happening, we had pretty much the same kind of a top here on, those were mostly equal. So that to me was a divergence that I should have picked up on, but I don't look for those typically because these indicators go in the same direction nearly all the time. So I didn't pick up on it. I wish I had, because we see that we had this nice rising trend, and then we ended up having this divergence, and right after that we had this very big decline. So I did the difference between two indicators. I looked at divergences between indicators, and that gave me some information to look for in price. So that's a little bit more advanced, but that's how that works, and you can do that. And finally, let me look at these intermediate term indicators, and we'll look at a few advanced hidden divergences. All right, so we have rising bottoms here because we're starting with price for a hidden, and now we see declining bottoms that match that. This, remember, let's see if you can remember, this is considered a hidden bullish divergence. So again, it's sort of, to me, it doesn't make sense to me in my head necessarily, because I'm looking for the difference in an indicator. And when I see declining, I'm looking at declining tops. I'm not looking at declining bottoms. So it can be confusing, because declining tops and rising price tops is a negative. And this is confirming the downtrend, right? These two tops right there. But the hidden divergence, as you say, is these declining bottoms and rising bottoms, and that's considered bullish. So we got the decline off of this. Well, we got the confirmation of this decline, and now we're starting to see, as far as a hidden divergence, we're seeing these bottoms declining on the indicator, but we're getting rising bottoms on price. So a little different. And like I said, the reason I don't generally follow them is because it can be very confusing when you're looking at them. And with that, I'm going to complete our Divergences and Confirmations workshop, and away we go. Here's what we covered again, just to refresh you. We looked at rising bottoms and declining tops. Again, think of those all the time. This is a good refresher for people anyway. It's natural for most, but I explained the psychology behind that. Then we looked at classical divergences and confirmations. And then we talked about some advanced methods, finding those hidden divergences that are not typically used in TA. And then we looked at converging and diverging moving averages, and of course the MACD, which is a indicator for converging and diverging moving averages. So with that, I am concluding, and I hope you enjoyed my workshop. I hope you learned something, and I would be very pleased if in the survey below, if you could go ahead and let me know how this was. And for a reminder, these charts, if you do want these charts, are going to be in the April 13th Market Watchers Live blog entry. You'll be able to see and take these charts with you if you'd like. And that's it, Tom. I'm all done. Are you about ready for that 10 in 10?
I am ready. First of all, great presentation. I think all of our viewers certainly appreciate the time you put into it, and a lot of very timely topics, no doubt about it, with all the movement in the market, trying to figure out whether or not the moves are being confirmed or whether you have divergences and so forth that you have to pay attention to. Anyway, I thought it was very timely, so great job.
Thank you. Thank you very much.
All right, so we are going to give Erin some time off. I have a list of some of the requests. I'm going to go ahead and skip through looking at the RRG. I think just in an effort to kind of get us back on schedule here, let's just jump in to the stocks. So the first one that was given was VSTO. And this is a Vista Outdoor. So what I did, I've got 10 stocks. I've already annotated 5 of them. So we'll go through these pretty quickly, and then the last 5 I'll annotate. We'll get into a market update, talk a little bit about ChartCon, and then we will bring Erin back in to give us an update on the sentiment. So here we go. We got VSTO. First of all, notice that after we had gapped down on heavy volume back in November, we really struggled to get through about 15.5 to 1575. We finally did that in the second week of February with increasing volume, got all the way up to 20, came back down, and even though this was a big gap down in heavy volume, I think that there were some bullish, there was actually bullish behavior here, because we had lost the bottom of gap support intraday, and we came back and closed well above it. We left that long tail to the downside, and with heavy volume and a long tail, that means there was some buying taking place. Maybe value investors, maybe some technicians seeing that this gap had been filled and we were seeing reversal. But whatever the reason, we did have big volume. We held on to gap support. And then we sideways consolidated for about 3 or 4 weeks before breaking out to open up April. And look at the volume picking up again as we start to rise higher. I think VSTO looks pretty good here. I like the moving averages as support to the downside. And I'm looking for this stock to make a move and test the February high around $20. The next stock, Walt Disney. And I have to say, this was one of the stocks that I had predicted at the beginning of the year. I thought this was a stock that would do well. Of course, we've gone into a lot of consolidation, a lot of volatility, and this is one of the stocks certainly has not done well. Many of the Dow stocks actually have not done particularly well, but Disney has been declining. I did draw a couple of support lines that I would keep an eye on. The recent lows, now that we're seeing the volatility index begin to dry up a little bit, perhaps we've seen the lows. So I would watch these recent lows at about 98, 98 and a half. But I think the biggest support level on Disney going forward is just below 96 back at that September low. We did put in highs that took out the late July, early August high. So I think we still have a pattern of higher highs, higher lows here with Disney, but that would violate it, moving down below that low we saw in September. So watch that. Next up, Applied Materials. This is a stock in the semis. This I'm using my relative charts for. I thought this was a good one to kind of highlight what's been going on. Before I talk about Applied Materials, I think it's important first to note that Applied Materials is in the semiconductor space, which has been doing extremely well. And if you go down here and look at the semiconductors relative to the S&P 500, they have been outperforming. Yes, they go through periods where they pull back. They've got to take a breather. But overall, you can see that this has been moving higher and higher from left to right. So since April, May of last year, this is a group that has been performing really well relative to the S&P 500. One concern I have with Applied Materials right now is that since back in October, we have been seeing relative weakness among its peers. So it's not that it's a bad stock. I mean, when you look at the chart, I don't see anything horrible. I mean, as you go up, we got higher highs, higher lows, higher highs, but its relative strength has definitely begun to pull back relative to many of its peers in the semiconductor space. So I think there are others in this area that have done much better and have been doing much better. I'm not bearish Applied Materials. I just think that you have other stocks that have been performing better. Now, over the last 6 days, we have started to move higher. We've broken back up above the moving averages. And when we look here, you can see we're showing a little bit of relative strength here over those last 5 or 6 days. I'd want to see that continue with Applied Materials. So if I was in this one and it started losing its 20-day moving average and started failing again on a relative basis, that might indicate to me maybe I just need to switch into a different semiconductor stock. JD.com, ticker symbol JD. It's been downtrending here for the last few months. The overall market, has tried to move back up, and on a relative basis, the stock clearly is not performing as well. As you can see, it is struggling at its 20-day moving average. That's what these two red arrows mean. And even on this last advance here, you can see the volume's been dwindling. So this stock, I think, just needs a catalyst. It broke down on pretty heavy volume below this double bottom at 42. So I think the combination of the 20-day moving average and $42 price resistance, that area needs to be negotiated before I'd be more bullish here. The last one that I had pre-annotated, SLCA, a beautiful positive divergence. This is, kind of timely with what Erin was just talking about in her workshop. But you got prices moving lower, and in this case, because I use the PPO as my momentum indicator, that has moved higher. So price is lower, movement's gone, the PPO's gone higher. That's a positive divergence. What do I look for? I look for a 50-day test, and I look for a centerline reset. And we have gotten the 50-day test. We're about to the centerline reset. The other thing, as we are making these new lows, look at the volume in here. Volume was pretty light compared to what we saw in February. So that was another indication maybe that the sellers had dried up. Another indication maybe that the momentum to the downside was slowing, and now we have seen a pop back to the upside. Now, there is a lot of overhead resistance here at about $27.75 to maybe $28. Here's where we gapped down and sold off from on very heavy volume, and we haven't been able to get through that level. And if you notice where this arrow is, we went almost right up to 28 back on Wednesday to challenge this high, and then we backed back off, but we held the 20 days. So I think this is squeezing now in a very important range between about 26 and 28. Let's see which way it breaks, and then we'll move from there. The next stock is Lowe's, L-O-W. I'm going to go ahead and annotate. But I think this one looks very similar after a big gap down, not very similar to SLCA. After a gap down right here on very heavy volume, you can see the volume. We did try to rebound a couple of times, but we have failed so far. And this volume right here. So big gap down. This was the reaction high. We gapped down to about 87 or 87 and a half. Couldn't close back up above 90, and you can see we haven't had an open or a close above 90. That 50-day moving average is coming down. Let's get some volume and get through 90. Until that happens, I'm not interested. All right, so that's our 6th stock. Let's move on to number 7, which is Rio Tinto, RIO. I think it's holding on to its key support around 50. I think off of a move to the upside, it's been consolidating, which I find to be pretty bullish. So there was your low off of that early February selling. We went back to a new high, and we did have an intraday move below that low, but we haven't closed below it. So I think 50 is your support level. Resistance sits up around 57. We're in the middle of the range, so I'm not sure I'd be a buyer or a seller at this point. But it is in a nice space, which is moving higher. And so I give it a better than 50-50 chance that it's going to make its way back up to that 57 level and test the February high. I would be a seller there until we get a confirmed breakout. All right, so that is a Rio, which is number 7. Let's take a look at Marathon, MRO. Marathon Oil having another great day. Look at the volume. That's one thing that's definitely sticking out to me is on this rally. This is not a light volume rally. This is a nice, heavier volume rally, which tells me that we probably have some accumulation taking place. I think that your price support now, we had some resistance at about 1690 or so. That was back in mid-February and tested again just last week. And we have since broken out on some good volume. So I think that price support just below 17, along with the rising 20-day moving average, is what you want to watch. I think it's making a run to hit and test that late January high up close to 1950. That's where I would expect it to go. I would be a seller there again, waiting to see if we can get that breakout. All right, next up is INFY. All right, this stock just reported earnings, so I would like to see it settle down a little bit. But so far, I have mixed issues here. Number one, that was a prior low that you can see from the pullback in the second week of February, and we're below that. So that gives me a little reason to pause. But there is some significant gap support. Look at the heavy volume gap up here. We gapped up from about 1675. We're leaving a tail below 1675. If we can finish strong today, I think we might be setting a bottom. So these are the two levels that I would be watching. A little bearish because that first initial support level failed to hold, or at least is failing to hold so far. But the key one to me is going to be this gap support. If we can rally into the close on this kind of volume and leave a long tail below, we could be setting a bottom on INFY. All right, and that was number 9. So last one is going to be ULTA. I'm a fan of ULTA. And before I annotate the short term, I just want you to look at a long-term chart of this stock. This is a really nice company. They've got a nice brand. You can see on the long, actually, let's go ahead and just annotate this. I'm going to shorten it though. From 15 years, let's just go to 10. Why not look at a monthly chart? For those who like to look from a longer term perspective, I think you got a great stock here. But after running up for many, many years, we did, over the last year or so, we've struggled. I think it needed a little bit of a reset here on from a negative divergence, a long-term negative divergence. Anytime I start looking at monthly charts and see negative divergences, that can be a problem for quite some time. And that's exactly what happened here with ULTA. So you can see the move up. You can see the PPO lowering, that monthly PPO, negative divergence. So what am I looking for? I'm looking for a 50-period test, which you can see we got last month. And I'm looking for a center line test, which it appears we are just about there. So I look at the long-term chart here, and I'm pretty bullish ULTA. I think that a lot of the selling could have ended, and a breakout on the daily chart, and I'll look at that again for you in just a second. But let me go ahead and save this annotation. But I think a breakout on the daily chart, which we'll look at now, would be very bullish, and we're trying. You can see all these tails just above 220. You can see this close up around 222. Just earlier this week, we were 221. Today's high is 223. A pullback to the 20-day moving average, I think, would be an interesting entry because I do think it's beginning to regain strength. Look at the volume that came in on these 2 days back in the middle part of March. We pulled back, put in a long tail below this low, and now have started to move back up again. I think we're reversing. I'd be looking for 245 to 250 to test these highs, but of course we need to get this breakout first. So ULTA, I think, looks very interesting. And that is it for the 10 in 10. So here are your stocks for today. VSTO, DIS, AMAT, JDSLCA, LOW, Rio, MRO, Infi, and ULTA. And with that, let's keep on moving. I'm going to continue to allow Erin to take a break here, but I do want to talk about, at least briefly, I want to talk about ChartCon. It is an absolutely unbelievable value, in my opinion. I think it's one of the best, if not the best, conference that you can attend. You can attend it obviously live, but more importantly for many of you, you can attend it just like you're attending this, our chart watchers each day, literally just watching from wherever you want to watch from. Go to Starbucks, you can watch from your living room. Very, very convenient. And the lineup that you're going to see is as good of a lineup from a technical analysis standpoint. It's probably the best lineup I've ever seen. You've got some titans in the industry. You've got Martin Pring, Dr. Alexander Elder, Tom McClellan. Of course, many of you probably use the McClellan oscillator. He's been on the show here. Just absolutely brilliant folks. And so you look through the schedule, and everyone is going to be addressing risk and what that means to them. And so, just look at what we've been through the last couple of months with the volatility and the movement to the upside and trying to decide, is this bullish? Is it bearish? Are we in a bear market? Is this just a correction? This is going to be a conference that I think is going to be very timely because for the last 2 years, we never really saw much in the way of downside action in the market. Now, all of a sudden, we've got it. What does it mean? How do you deal with it? How do you minimize risk? Not only during up markets, but in scary markets like we've been seeing here more recently. So check it out. I do want to point out that there is an early bird special right now. So you can see that original price, $299, being marked down to $199. That expires in less than a month, May 5th, and time flies. Don't make a mistake and miss out on that early bird pricing. Okay, with that, let's take a look at a final market update. I do have a different update that I'd like to point out that we can go over, and we'll try to do this pretty quickly. But I'll show you. You get a chart list, and I've got 12 symbols in here. You can bring it up 10 per page. I can change it to summary if I want. You can take a look at it that way. I'm going to do it in candle glance. So let's take a look at what's going on here. Dow Industrials down 68 points. So we did, we're kind of hanging. It's like the market doesn't want to sell off like it did before, which I think is a good thing. The S&P 500 down just 2 points. Nasdaq only down 12. The Russell 2000 down 4. All of these indices have broken above the 20-day moving average and now trying to hang on above the 20-day moving average. The S&P 500, you can see, went back down, tested it, trying to move back up. And I think this is the 20-day simple moving average. I actually think the EMA is slightly above this one. But I would be watching around 26.55 on the S&P 500. That's what I'm watching. If we had a big sell-off this afternoon, the VIX soars, I'd feel a little bit differently about this market going into next week. But right now, I think that things are starting to turn back to the upside. Banks, if we could rally in banks later this afternoon, I would be even more bullish heading into next week. But anyway, we've got the gold miners, as you can see, having a great day here. Miners in general up over the 92 level. Last 4 or 5 days, we've seen big moves in this area. Internet stocks trying to get through the 20-day moving average, definitely struggling on a relative basis, but a breakout there would be bullish. Railroads, and I just went through and was looking at some of the charts I thought were interesting. I mentioned railroads in my blog this morning. I think the transports have started to strengthen, and a move back through about 1825 would be bullish on the railroads. Home construction has been under fire. This really surprised me. After seeing some real nice strength to open up April, you can see we have been moving straight back down. We're trying to put a bottom in here. Clearly, a line has been drawn, though, at around 800. We want to watch this level closely on home construction. The drug retailers are down almost 1% today, and they too, like internet stocks, really struggling to get back through the 20-day moving average. There's the banks. We've talked about that a bunch today. I won't go back into it. And here's asset managers, another group within the financials. And you can see the low 220s had acted as support. We went through it, and we've been struggling in the low 220s as we did earlier today and at the 20-day moving average. This is another group we'd like to see get a breakout. And the asset managers had a nice earnings report out earlier this week with BlackRock. So it's not like the index doesn't or hasn't had a catalyst. We need to see that technical movement back to the upside and not rely just on the fundamentals. We need to see it in the technicals as well. All right, a couple more things here before Erin goes over the sentiment with you. I do want to give you a couple of stocks that are hitting 52-week highs today. SKX, Skechers, Erin and I have both mentioned this stock recently. I think it may have been mentioned with Momentum Sleepers and maybe one other time earlier this week. But you can see that it's having a really nice week. It has broken out above recent consolidation. I find that to be bullish. Volume picked up a little bit, and you might say, well, it's still pretty low volume. Well, a lot of it's because this volume over here is so heavy. So if we actually move to 5-month, I think you'll see that the scale on the volume improves. And clearly, volume picked up on the last couple of days as we made this breakout, which I think is bullish. ETSY, Etsy, this is one I know Erin has talked about on many occasions, been a great performer. I don't like today's candle, though. It did break out. It's got a negative divergence, so you've got higher prices, negative divergence, and we are potentially putting in a pretty bearish-looking candle here. I think this is a stock that could reverse maybe down to the 26.5 area to test its recent low, possibly even down to that 50-day moving average. Unless we get a big reversal later today back to the upside, I don't like that candle and the increasing volume with a negative divergence. A couple of others here. Let's see. Let's take a look. All right, let's take a look at HES. And I'm going to pull this one up on my with my relative chart. You see the breakout there, which has clearly been, clearly a very nice move today on HES. And the volume is okay. It's been very strong the last few days, making this push to the upside. But if you take a look at the underlying index, it's starting to strengthen. It's made a recent breakout. Look at how HES is doing relative to its peers, though. So you've got a relative leader here. And even though it's been in a group that is nowhere near its high back in January, look at how HES has done relative to the S&P 500. It has been able to outperform. So the group is starting to gain strength versus the S&P 500, and HES has been one of the top performers making a breakout. That, to me, if I was going to go into energy, these are the types of stocks I'd be looking for. Now, you might say, well, it's been up for 5 or 6 days in a row. No doubt about it, I'd prefer a pullback, but this is a stock, because of its relative strength, that I would be looking for entry into. And let's do one more. There was one more. There's got to be one more here that was really interesting. I know PVH. This is one that John Hopkins had mentioned that he was looking for maybe to pull back at some point. The stock's been on fire. This is its recent earnings report, the gap up, the breakout above the prior high. PPO is strong, but we do potentially have a reversing candle. And if that holds into today's close, perhaps we will get a pullback to test that rising 20-day moving average, which is just above the 152.5 area right now. And with that, let's wrap up this final market update. And I am going to turn it back over to Erin. Hopefully your voice is well rested and give us all a sentiment update.
Absolutely. Before I do that, though, somebody had asked about divergences on Amazon as a example. So I just want to show that very quickly because actually it is a really good example here. So I'm going to get my trend line, trusty trend line ready. So first of all, I'm starting with my indicator and I have a declining tops trend line here. And what's going on with corresponding price tops? They're rising. That's a bearish divergence, so I should expect a trend reversal up here. We actually got that. Once we hit that bottom, I consider that a reset, as you'll call it, Tom. We got that decline. Now we're starting to rise back out. Some people might say, well, wait, you've got the OBV is confirming this uptrend. That's a rising tops trend line. That doesn't work. So remember, that isn't valid. The only way you could use that would be if you have the divergence in terms of, you know, declining tops, because remember, hidden divergences, also considered reverse divergences, that's the only time you'd use these rising tops on a when you're doing your analysis as far as divergences go. And let's see, I had one other in here that I saw. So this wasn't actually a, you know, confirmation of the uptrend, because again, that's, you don't draw rising tops lines, but we do draw rising bottoms. And the corresponding price bottoms here are right here and over here. So you can see that we're getting a bullish confirmation out of this bottom that we saw. And honestly, I was looking at it. You could make a case for an island here. I think more likely we're looking at an ascending triangle. So again, you're looking for an upside breakout. So I thought that was a pretty good example. Thank you, whoever suggested it. I thought that was excellent. So at this point, the divergences are saying that, and even the chart pattern are telling me that that we should expect more upside out of Amazon. So let's go ahead and leave from here and move over to sentiment. And here we go. These are most of the sentiment indicators I use. I'm only going to show you the group that are the most useful in my opinion. The others kind of have a large lag. Let's make this bigger. All right, so we're going to start with the put-call ratio. And sentiment is contrarian. Sentiment is contrarian. If everybody is bearish, that's bullish for the market. If everybody is very bullish, that's bearish for the market. So remember, sentiment is contrarian. So in this case, when we're looking at a put-call ratio, because the calls, the bullish part is on the bottom, the denominator, the larger and larger that gets in comparison to the bearish puts, tells you that you're going to get a reading that's lower and lower and lower and lower. And that means that people are getting more and more bullish and bullish and bullish. And that, again, is bearish for the market, contrarian. So what we're looking at right now as far as these ratios go is we already peaked. And that's typically when you should start expecting upside movement. Because remember, high reading, investors are bearish. And that's bullish for the market. So we got that top. We should have expected a move to the upside from there. Well, we can see we're getting from here in April. I mean, we're trending higher. It's been more chop, more consolidation than anything else. But I just wanted you to note that we're now seeing a decrease in these ratios. And that means that people are starting to get a bit more bullish as we're moving along. We're not seeing bullish extremes. Now, if I start seeing readings well below 1, you know, we're looking at a 0.8, 0.9 readings, then I might get a little bit concerned about the fact that people are getting, that investors are bullish. But right now, they're getting bullish. They're not really bullish yet. So let's look at AAII. American Association of Individual Investors, people like you and me, can go to their website at AAII and vote. Are you bullish or are you bearish? Which does happen to be the poll we are running right now, pretty much. How will the market close next week? Currently, half of you say higher, 28% of you are saying lower, and 20% are neutral or mostly unchanged is what they think the market will do next week. So we'll have to do a comparison at the end of the week to see if you all were correct or not. So what I wanted to point out on this chart is, of course, we're getting fewer and fewer bulls and more bears. People are getting more bearish, more bearish. And now look at the reading we have currently on that bull-bear ratio. We're now in certainly oversold territory. This is readings previously where we've had these kinds of low ratio on the bull-bear ratio. And look what typically happens out of that. When people are very bearish, you should expect some upside movement. In this case, of course, it didn't quite work out that way. but that's all right. So we want to see people get very bullish or bearish, and that's bullish for the market. And again, I've marked some areas where we've had that ratio move very low. Typically, you're going to see a rally out of that. So let's go ahead now and look at the National Association of Active Investment Managers, I believe is what NAIM stands for, the NAAIM exposure list. So this tells us how exposed money managers are to the market right now. Currently, you can see in the thumbnail especially that we're getting more exposure out of money managers. That means they're starting to get a bit more bullish. Now, in this case, I'm not really going to look at this difference in a bearish manner. The fact that we're getting more exposed, typically when you get very exposed, that means you should start looking for that reversal. But in this case, I'm going to say that I think the fact that active investment managers are starting to get more involved in the market right now, considering we're coming off of this low, I think that tells us actually that that's a bullish feature. The big money is starting to expose themselves more, but we're not talking about over exuberant readings here of exposure. They're not like throwing it all into the market right now, but they are starting to inch back in. And I think that actually is bullish for the market. So, sentiment is contrarian, but really that makes more sense at the extremes than in the middle. All right. Let us look at, well, here's our Wall Street sentiment survey from last week. These are market timers. I'm actually polled on this. The market timers give their information like we have in that poll right now. Do you think the market's going to close higher or lower next week? And you can see that this last week, everybody was pretty much split. We had 40% bulls and 40% bears, and 20% saying, I just don't know. I don't think we're going to see much. So when you see these even readings, I mean, that's just as neutral as you can get for the market, and really as neutral as you can get for sentiment. There's just nothing there. It doesn't tell you anything if you have sentiment where both you have the equal amount of bulls to bears. I mean, doesn't that make sense? There's indecision, so that would be neutral for the market. What I'd like to look at now is our RIDEX asset analysis. And there are quite a few things I'm going to point out on this chart. And I think there might be some divergences in here. I might be talking about that. I can't remember if this is really what I wanted to say about it. But what I do want to say is we track a basket of funds. They used to be managed by RIDEX. RIDEX is now part of Guggenheim, but we kept the RIDEX name. They had a group of funds. There's still these group of funds. Obviously, they still exist, just under a different name. In that closed group, you have bear funds, you have bull funds, and then you have on the outside money market assets. So RIDEX, Guggenheim, they report how many assets are in these groups. And by tracking where the money is going, the actual money, not the click, I'm bullish, click, I'm bearish, this is actual money, similar to the name exposure index, what's really going on, where's the money going. So I think this is a really important chart. That's why I follow these pretty closely, and that's why I present it to you every week, because I do feel like it's very important to understand where the money is going, because that's going to tell you more about what's the actual sentiment going on. So what I want to point out this week is that you're seeing pretty much a stagnant pool of money in the bear funds. We're not seeing an increase. We're really not seeing a decrease. We're kind of moving sideways. What's interesting is that we're seeing assets moving out of the money market funds. People are moving out of the cash, and where is it going? It's going toward the bull and sector funds, toward the equities. And so that means that investors are starting to feel a bit more bullish. We're not seeing a big decrease in the bear funds. So we're not seeing a extreme reading of bullishness out there. We're seeing a switch. We're seeing a gentle move by investors. They're looking at this recent bottom and they're starting to feel a little better about the market. So they're moving a bit out of cash. And rather than going into the bear funds, which would mean they're feeling very bearish, they're moving them into the bullish funds. But they're not pulling their money out of the hedging. There's still that hedge out there. It's about even because the bear funds are still traveling mostly sideways. Now, we also track the bear bull ratio. The bear, as far as the numerators, the bear funds, and we put the money market assets in there because they're not, it's not actively being invested. Typically, if you're in cash, you're feeling more neutral to bearish. So we combine those for the top in the numerator, and then all the bull assets are in the bottom. So I track this ratio because a lot of times you look for these breakouts and they can give you some very important information about what's going on. You can also look for divergences here as well. So right now, what I wanted to look at is when we see our ratio with declining tops and we get these breakouts, that's typically a reversal point. That's typically telling us we're going to see a reverse in the trend. And you can see it was pretty much spot on back in the end of November and especially at the beginning of March when we got that breakout on the ratio. Now we haven't quite gotten there yet as far as the past two tops. We're getting close. We're about ready to pop up through the top, and that would be confirming really this rising trend. We're still, again, a lot of consolidation sideways, but you can see we're trying to break out right now above that previous top we had last week. So I think that's all good news. I should say, so I would say sentiment is looking up, and we're looking at, well, even if you look at this, you can see an ascending triangle on price, and that's a bullish formation as well. So if we get that breakout as expected, then we can expect some more upside out of the market. So that's what I really wanted to cover as far as sentiment. And we can go ahead and look at our summary chart right now. So when we looked at the put call ratio, they are moving lower out of those tops. But again, we're starting to see a shift in the sentiment, not extremes. So I would say we're still looking bullish for the market. AAII, we're seeing a very low bull-bear ratio, and that suggests that investors are very bearish, and that would mean that's bullish for the market. And in the name exposure, we can see there was a slight increase in those exposure readings, but in this case, I'm going to read it as bullish because it's more of a tiptoe into the market by the big money. So I would say that they tend to be on the right side until it gets to extremes, but we're not at extremes. RIDEX ratio, we're looking at a decrease in the cash, and that's going into equities, not into bear funds, and those are staying stagnant. So again, we're seeing this slow reversal of the sentiment starting to move bullish. And in this case, I'd say as far as the RIDEX ratio, I'm looking at that as more neutral for the market. So when you look at the conclusion, we're looking at sentiment being mostly bearish, and of course, that's bullish for the market. So at this point, I would say sentiment is pointing to a bottom and continuation of the rally off of that low that tested the February low. And so that concludes it.
Are you bullish for next week based on sentiment, or what?
Yes, I am bullish, actually. I'm going into next week as a bull and not a bear, which I've been going in, I think, the past 3 weeks as a bear. So I think we are looking at a short-term rising trend getting ready to hit. I don't know if it will be enough to kickstart the bull market, but I know Greg is kind of in that same camp. We're looking for a short-term rally, but then after that, probably another move back down.
Okay, cool. All right. I think based on those huge spikes in the VIX and the VXN, that they marked some pretty important bottoms for the market. So I don't know if we're going to go racing higher like we were, toward the end of 2017 into 2018, but I do think that the bias over the next few months is going to be back to the upside, but we'll see. We shall see. There was a question that came in the room. Somebody was asking me whether or not, I think it was about the 50-day moving below the 100-day moving average. I'm not sure which chart that was being referred, but I will say this: anytime that you have a short-term moving average that moves below a longer-term moving average, that's generally not a good thing. I mean, I don't follow the 100-day moving average. There are some traders that do. I tend to follow the more common moving averages, which to me are the 20 and the 50-day, because I think if I'm trying to expect what other folks are going to do based on the charts, I need to be looking at charts that are similar to what they're looking at. So that's why I tend to stay with defaults when it comes to moving averages and indicators and that sort of thing. And I think that is about it. Did you have anything else to add before we get into next week's?
No, I really don't. If you want to read more about divergences and confirmations, Chart School has some very interesting information. And I think somebody mentioned that stochastics are a little different in the way the divergences work. Check that out on Chart School. That, of course, can also be the case depending on what indicator you use.
Well, I will say I am not a fan of using divergences with stochastics, mostly because they will reach their outer boundaries quite often, 0 to the downside and 100 to the upside. And if stochastics hit 100 at a price high, the next time you get another price high, what's the chance stochastics are going through 100?
Mm-hmm.
0, because you can't go above 100.
Yeah.
So I think sometimes stochastics will give you divergence readings that simply, in my opinion, just don't make any sense, any common sense anyway. That's just my take.
Agreed.
All right. Well, it is time to wrap up. So why don't we get into next week's schedule, and then we'll, I don't know, I guess bring this week to an end.
Yes, and get ready for next week. I'm very excited. As you can see, we're going to have Tuesday. We've got everything stock charts. Our guest on Wednesday, Guest Wednesdays, Tim Ord from the Ord Oracle. You can see some of his blog articles in the Top Advisors Corner on the blog page. And Julius, our resident blogger, is also going to be here on Thursday to talk RRG. Can't wait. And on Friday, Tom, you're going to be doing a workshop of your own. Do you have any ideas what you're going to talk about?
No, I don't even know what I'm going to do for dinner tonight.
I'm sure you'll take suggestions in the survey. So go ahead and fill out that survey at the bottom.
Absolutely. I want to thank everybody for joining us today and this week. Please remember to complete that survey that Erin was just mentioning as you exit. We do love to get your feedback to hear what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, everybody. Enjoy your weekend. Be safe, and we'll see you back here on Monday. Happy trading.